Hello, Doctor. We are Group 5. So today we will presenting our financial analysis and strategic evolution of Zealand Bahad. Our presentation is structured into several key parts. We will start with a brief overview of the company and the implication of pn17 classification. Then we will analyze its financial performance through income, balance sheet, and cash flow trends over the past 3 years. Beyond the numbers, we will dive into the strategic and operational weaknesses that contributed to the company's current position, from fragile business models to governance challenges. Using tools like SWOT and PESTLE, we assess both internal and external factors affecting Zealand's sustainability. Finally, we will conclude with five recommendations aimed at improving liquidity, restructuring debt, embracing digital transformation, and rebuilding stakeholders' confidence. So let's begin with an overview of Zealand and its current PN17 status. In this part, I would like to introduce our focus company, Zealand Bahad, and explain why it has been classified under PN17. So let's start with a quick snapshot. Zealand Bahad is a Malaysian engineering and construction company. It was founded in 1976 and is listed on the main market of Bursa, Malaysia. So over the years, it builds a reputation in engineering and construction, along with property development and investment holding as its main business segments. So Zealand has been involved in major infrastructure projects, not just in Malaysia, but also in countries like Saudi Arabia, the UAE, and Indonesia. However, in recent years, the company has faced serious challenges. There have been project delays, cost overruns, and a consistent pattern of net losses. So, on the top of that, the company stakeholders' equity has turned negative, which is a clear red flag in financial health. As a result, Zealand was classified under PN17 on July 28, 2020. So now, just briefly, what is PN17? It was a financial distress framework established by Bursa Malaysia. A listed company falls under PN17 if it shows signs of several financial weaknesses, such as sustained losses, negative equity, or loan defaults. So in Zealand's case, it's triggered PN17 status due to its ongoing net losses and negative stakeholders' equity. So once under PN17, the company must publicly disclose its status and submit a regularization plan within 12 months. If it fails to do so, it faces possible trading suspension or delisting. So, in short, PN17 is a wake up call both to the company and the market to act quickly before the situation becomes irreversible.
This part is about the company's income statement analysis. Zealand's total revenue decreased by 39.8% from 2022 to 2023, but increased by 32.5% from 2023 to 2024. The increase in 2024 shows the recovery or growth compared to the previous year. The gross profit decreased significantly from 2022 to 2023, but it improved by 10.5% from 2023 to 2024, still below 2022 levels. The operating income fell sharply from 2022 to 2023 and slightly improved by 12.4% in 2024. The overall decline shows that maintaining operational profitability is difficult for Zealand. Interest income decreased significantly from 2023 to 2024, while interest expenses remained relatively stable. This indicates that Zealand's ability to generate income from interest in 2024 was weakened, which could hurt its profitability. Zealand faced a significant net income loss in 2024, a considerable decline compared to 2023. It's important to consider the non-operating income and expenses, which are impacting net income. In conclusion, Zealand has seen significant fluctuations in its financial performance from 2022 to 2024. In 2024, the company reported a large net loss, although there was a recovery in gross profit and revenue in 2024. the large non-operating losses still existed. This part is about balance sheet analysis. The total assets have been decreasing from 2022 to 2024, especially from 2023 to 2024. The total assets decreased significantly, suggesting assets impairments or potential divestments. Zealand's current assets decreased significantly from 2023 to 2024, possibly due to changes in working capital or the sale of short-term investments. The current liabilities have been relatively stable. A slight decrease from 2023 to 2024 suggests that the company has no significant changes in its short-term financial obligations. However, the total liabilities have been decreasing from 2022 to 2024. This may indicate a reduction in debt service or financial obligations. Despite a reduction in total liabilities, the company's liabilities continue to exceed its assets. The sharp decrease from positive equity in 2023 to negative equity in 2024, which suggests that the company may be in potential financial distress. The negative working capital for 2024 is concerning as it indicates that the company may have liquidity issues, unable to cover its short-term liabilities with its short-term assets. The total debt has been reduced in the past 3 years, though the remaining level of debt is still significant compared to the company's asset base. In this part, I will analyze the company's cash flow statement. Firstly, Zealand generated a positive operating cash flow from 2022 to 2024. The decline in 2024 suggests that the operating efficiency of Zealand may have weakened in 2024. Secondly, the negative financing cash flow during the past 3 years indicates that the company is repaying debt or other financing activities, but the decrease of financing cash flow in 2024 compared to 2022 indicates that the company may be reducing its debt. Free cash flow has decreased from 2023 to 2024, which could limit the company's ability to fund investments or reduce debt. Finally, Zealand has relatively low investing cash flows. The investment cash flow in 2024 is much lower than in 2023 and 2022, which implies that Zealand has reduced its investments using a more conservative approach to capital expenditures. This part is about profitability analysis and liquidity analysis. The gross profit margin has reduced from 59.8% in 2022 to 49.4% in 2024, indicating that the company's ability to generate profit from its cooperation has weakened. The operating profit margin has significantly declined from 2022 to 2024, suggesting a large drop in the company's operational efficiency. The current ratio in 2024 indicates poor short-term liquidity, and the company's current assets are efficient to cover its current liabilities. It's a slight improvement from 2022, but still far below the ideal ratio of 1. Solvency analysis compared to the high debt-to-equity ratio in 2022, the situation has improved in 2024, but the negative debt-to-equity ratio suggests Zealand has negative equity, making it potentially at risk. The interest coverage ratio in 2024 showing that Zealand's earnings before interest and taxes are not enough to cover its interest payments. This ratio decreases sharply compared to 2023 and 2022. Efficiency analysis: the asset turnover ratio has improved slightly in 2024, but remains low, indicating inefficient use of assets to generate revenue.
Let's move on the strategy interpretation, both financial and non-financial, to understand the root causes behind Zealand behavior's decline. We have broken this down into four main areas: financial red flags, operation fragility, strategy leadership and competitiveness, and strategic outlook. Now I'm going to talk about the Zealand Beerhead's financial performance over the past 3 years. Let's start with 2024. The company reported a net loss of 252.23 million ringgit. That's a huge drop compared to the profit it made in 2023, and it clearly shows a major decline in its core business. Now, although revenue improved slightly and gross profit went up by 10.5%. This gain a quick surprise when you look at the bigger picture. Digging deeper, there are several financial red flags. First, the gross profit margin fell from 59.8% in 2022 to just 49.4% in 2024. We can look at the picture. The operating profit margin dropped even more sharply, from 64% down to 30%. What this tells us is that Zealand is struggling to control its costs, and its overheads are rising faster than its revenue. But here's what's really concerning. The net profit margin from 2024 was negative more than 600%. That's pouring to mention no operating losses, possibly from asset write-downs and bad debts. Liquidity is another serious issue. The current ratio in 2024 was only 0.33. That's way below the standard benchmark of 1, which means the company may not have enough short-term assets to pay off its short-term liability. The negative working capital just confirms that Zealand is under a lot of financial pressure. Look at this capital structure. Things doesn't get better. The debt to equity ratio has turned to negative, which means the company now owes more than it owns. On top of that, its interest coverage ratio is negative 9.92. In practice, they are not generating enough earnings to pay that interest expenses. That's a major red flag when it comes to servicing. In short, Zealand Beerhead is facing serious challenges. The company is losing money, struggling with liquidity, and carrying a weak capital structure. Without a thorough turnaround plan, the issues could continue to get worse. Looking beyond the financial data, now let's talk about Zealand's operational fragility. Zealand relies heavily on large-scale overseas projects, especially in countries like Saudi Arabia and the UAE. These types of projects can be very profitable, but they also come with major risks. We are talking about regulatory hurdles, complex logistics, foreign currency exposure, and even particular instability. Unfortunately, Zealand hasn't managed these risks well. Another problem is low diversification, with so much depending on just a few big contracts. Any delay or cancellation has a massive impact on the company performance. This concentration risk hasn't been properly addressed. On top of that, we see weakness is asset utilization. In 2024, the asset turnover rate was only 0.094. That's very low for a construct company. Even if it's slight improvement from the year before, it's just the resource aren't being used efficiently. It suggests that resources aren't being used efficiently, possibly due to the poor project choice or outdated bidding risk assessment practice.
Hi everyone, today I'd like to walk you through the strategic interpretation of the land behind's current situation, focusing on both financial signals and deeper non-financial insights, particularly around leadership, governance, and the market competitiveness. Then let's begin with the leadership and governance side. So, despite clear signs of financial stress over the past few years, such as declining margins and liquidity, the company's response has been positive. There is no evidence of major leadership changes, no restructuring innovations until its pn17 classification, and limited transparency in communicating with stakeholders. The repeated non-operating losses clearly suggest its weak internal controls and lack of proactive risk forecasting. And in other words, the warning signs were there, but were not acted upon. Governance structure also appeared outdated. The board does not seem to have introduced an innovation, sustainability strategy, and or digital roadmap, three key pillars for future survival in this industry. This disconnect is especially dangerous in today's fast-evolving structure sector. On the market side, Zealand's classification as a pn17 company significantly damages its credibility. It now faces reduced access to capital markets, lower investor trust, and inclusion from certain public-private sectors. And in addition, it's lagging behind the competitors who are already invested heavily in green infrastructure, AI-powered construction tools, and digital project management. So, simply put, Zealand is not seen as future ready, neither financially nor strategically. So, what should be done? We divided our outlook into two frameworks: short term stability and long term transformation. So, in the short term, Zealand must address its capital crisis. It means renegotiation debt, exploring debt to equality swaps, and tightening working capital, particularly around receivables and payables. And at the same time, the leadership team need to reform. This could include bringing in turnaround specialists or appointing independent directors to strengthen strategic oversight. And the transparency also matters. Clear, consistent communication with both investors and the employee can help rebuild trust. Long term, though, the must involve. This includes embracing digital tools like building information modeling, predictive cost tracking, and risk analysis. These technologies can improve efficiency, reduce delays, and sharpen project pricing. It also needs to pivot strategically, moving away from high-risk mega projects in overseas markets towards more resilient domestic infrastructure supported by public-private partners. And finally, ESG cannot be optional. Investors today are prioritizing environmental and social responsibility. Zealand must do the same if it wants to stay competitive. So finally, to summarize, Zealand's situation is critical but not irreversible. We've identified the key problems from profitability collapse and poor asset utilization to weak governance and market distrust. Each of those has a clear strategic implication and a realistic solution. From capital restructuring to governance reform, from digital transformation to ESG repositioning. Ultimately, financial survival depends on strategic revenue. So Zealand must not fix the numbers, but fix the madness behind the numbers. The next chapter of this company depends on bold leadership, agile thinking, and a commitment to long-term value creation. So that's all my part. Thank you.
So now I will talk about the fifth part, managerial tool application, and I will use two management frameworks, SWOT analysis and PASTEL analysis. The first is SWOT analysis, and the strengths, proven engineering expertise in energy and the infrastructure sectors. And the second is regional footprint across Southeast Asia and the Middle East, reducing geographic concentration risk. And the third is monetizable assets, including equipment and land, to support restructuring efforts. For the weaknesses part, chronic losses driven by cost overruns and project delays. And the second is excessive leverage with debt to equality ratio exceeding 2.56, indicating financial strain. The third point is poor liquidity, as current ratio remained less than 0.8 for 3 consecutive years. And finally, part is governance concerns, including delayed reporting and internal control weaknesses. For the opportunities part, the infrastructure boost, 95 billion ringgit allocated in Malaysia's 2023 budget opens new project opportunities. And the debt restructuring leverage pn17 framework allows negotiation for extended repayment terms and asset divestment potential, sale of non-core assets to strengthen cash flow and liquidity. And for the final part is threats. Fierce competition from stronger rivals like Gamuda and Sunway Construction, economic pressures from inflation and rising interest rates driving up costs, and reputation risk as pn17 status undermines client trust and bid success. For the SWOT analysis strategic implications, Zealand's main problems, poor liquidity, high debt, and weak governance, are more serious than its strengths. Because of this, the company may not be able to take full advantage of new infrastructure projects. To reduce risk like pressure from creditors and damage to its reputation, Zealand must act quickly. Debt restructuring and fixing governance issues should be top priorities. And the next managerial tool is PASTEL analysis. And the first part is a political factor. The government infrastructure spending. 12th Malaysia Plan drives the demand in the less core infrastructure sectors. And the next point is political stability and policy continuity. Policy shifts may disrupt project approvals and funding flow, and PN17 classification security.
Heightened security limits access to public contracts and investor trust. The next is economic factors, and first is inflation and rising input costs. Increasing prices of raw materials such as steel and cement and labor have raised overall project costs, affecting profitability for financially distressed firms like Zola. And the second is access to financing. Zola's PN17 status severely restricts its access to credit facilities and new equity investments, hampering its ability to take on new projects or fund operations. And the third is social factors. Urbanization and infrastructure demand. Growing urban populations drive demand for transportation, water treatment, and public infrastructure, all potential areas for the land to explore strategically. And the next is workforce demographics. The construction industry faces a shortage of skilled labor in Malaysia, especially post-pandemic. The land's limited resources may hinder its ability to attract and retain qualified talent. The fourth part is technological factors. The first point is slow adoption of construction tech. A limited capital hinders adoption of BIM and digital construction tools. Second point is opportunities in smart infrastructure. Green and smart city projects open doors for tech-enabled groups. And the next part is environmental factors. First point is regulatory push for green projects. Government bodies and investors now prioritize environmentally responsible development. The second point is ESG considerations. As ESG criteria become integral to investment decisions, Zola must demonstrate a commitment to sustainability to regain investor trust. And the next, finally, part is legal factors. The first point is construction regulation and compliance. The land must adhere to various Malaysian construction and safety laws, which add operational complexity and cost, and corporate governance requirements. So for the past analysis strategic implications, it shows that the land Berhad is working in a tough environment with strict rules and economic uncertainty. There are good opportunities out there, like government spending, smart infrastructure, and green projects, but the land may not be ready to take advantage of this. Its weak finances, limited tech capability, and damaged reputation could hold it back. So in conclusion, the SWOT and PESTEL analysis highlights the Lambert's urgent need for liquidity management, debt restructuring, and strategic realignment toward sustainable infrastructure. Without addressing governance gaps and macroeconomic risks, the company's PN17 exit prospects remain uncertain. That's all my part, and let's invite my partner to introduce the next part.
So in the final part, we propose 5 key recommendations for the Lambahad recovery. So first, the companies must address its liquidity crisis. A current ratio of only 0.33 highlights the urgency to manage working capital by speeding up receivables, optimizing inventory, and securing short-term financing. Secondly, capital restructuring is crucial. Despite reducing debt, negative equity signals financial instability. Management should renegotiate with the creditors, attract equity investment, and work towards a healthier capital structure. Third, digital transformation is essential. Automating operations and adopting data-driven tools can significantly improve assets utilization and overall efficiency. Fourth, we recommend strengthening governance and disclosure transparency. Clear, timely report supported by digital tools can rebuild stakeholders' trust. Finally, Zealand should rebuild its investor image through proactive communication and ESG initiatives, aligning with the modern expectations of corporate responsibility. So, together, these strategies provide a clear evidence based path towards financial recovery and long term sustainability. So, this is all about our Group 5's presentation. Thank you for your listening.